In the past month, we've seen many notable economists revise their inflation predictions upward for 2025. Consequently, Fannie Mae recently revised their mortgage rate predictions for 2025 to show that mortgage rates are likely to stay higher for longer and longer and longer. Data also shows that there's many homebuyers waiting on the sidelines to buy for mortgage rates return to quote unquote normal. But the reality is that our idea or prediction of normal is often wrong. See, the way the mind works is that we overweight recent experience as a predictor for what the future may look like. And so if you look at the last 15 years of mortgage rates, it feels like rates above 5% are the outlier. But zoom out, and longer term data shows that, in fact, the lower interest rate environment from 2010 to 2022 was the outlier. See, mortgage rates are traditionally based on the yield on the US 10-year Treasury note, plus about a 2-point spread to represent the additional risk as opposed to lending to the US government, as well as the cost to originate a loan. We have about 150 years worth of data on the US 10-year Treasury note, and the average yield over that time span is around 4.5%. So if we attach a roughly 2-point spread to that average yield, an average mortgage rate is actually closer to 6.5%, which is not too far off from where we're at today. The trouble, of course, is that many people have trouble affording homes. And the reality is there's still lots of tools that we can use, including interest rate buydowns or concessions from the seller to pay interest rate buydowns, to have a bigger impact on improving affordability than simply lowering the price. So if you have questions about how to buy a home, we would love to be a resource. Contact us today.